Hi there, this is Tantin. Today we're talking about why I've been buying slowly in recent weeks of oil company stock despite its recent run. Given that the Fed has suggested that it will try to kill off demand, there's a rising concern that the Fed would go over and create a full-blown recession just to temper rising inflation. However, due to the ongoing conflict, oil prices has been surging. Therefore, oil companies are making millions of dollars per gallon of oil sold. Even though President Biden tries to push these oil companies to produce more oil to lower gasoline prices, there's a huge gap in the number of pipelines. Therefore, no matter how much oil these oil companies want to produce, they are still capped by the pipeline infrastructure. One such company that have been buying and will continue to buy is Devon Energy. In today's video, we'll be talking about how I feel Devon will continue to grow despite the great performance at the start of the year. Before we continue, please smash the like button, and if you'd like to see more such videos, please subscribe to this channel. Firstly, we'll be talking about the business model of the company. Devon Energy is an energy company engaged in hydrocarbon exploration in the US. It's organized in Delaware and its corporate operating headquarters are in the 50-story Devon Energy Center in Oklahoma City, Oklahoma. Its primary operations are in the Barnett Shale Stake Formation in Oklahoma, Delaware Basin, Eagle Ford Group, and the Rocky Mountains. Secondly, we'll be talking about why I feel that Devon Energy will stand to benefit despite rising inflation. Given that part of inflation is due to rising gasoline prices, it supports the fact that many of us have no choice but to pay up for rising inflation. As most of us use some form of vehicle for transport, we are actually supporting the market. Even if President Biden wants these oil companies to produce more oil to drive up supply, it's extremely hard as there isn't a lot of pipelines to transport excess oil. Therefore, in my opinion, these companies have no choice but to either take over some small oil companies or produce the same amount of oil. Until President Biden gives up some ground and start building more pipelines, or the European conflict has been resolved, oil prices will continue to be elevated and Devon will start to earn huge profits. Moreover, Devon Energy could not spend all of its profits by drilling more. They have no choice but to raise its dividend rate. Given that we are currently experiencing rising inflation, this is great for potential investors who will say no to an 8% dividend. On top of that, it's both a variable and fixed dividend. They could raise its variable dividend depending on the price of crude oil. So if the price of crude oil continues to be this elevated, more money will be flowing into shareholder hands. As the stock market is taking a liking to companies that have high cash flow despite rising costs, oil companies have been in the spotlight recently. No matter how high oil prices continue to rise, Devon dividend will continue to grow. Thirdly, we'll be talking about the company's first quarter results. Total revenue of 3.81 billion came up short versus expectation of 4.01 billion. Adjusted diluted earnings of $1.88 per share was better than the $1.76 per share the street was looking for. The top line and the bottom line surged nearly 86% and over 300% respectively compared to the year ago period. We saw oil and gas demand severely depressed by COVID lockdowns and mitigation measures around the world in the second year of the pandemic. Rather than chasing current high oil prices with aggressive investment in production, which won't yield returns until well into the future, when prices may be lower, management is focused on producing what they have at capacity, keeping production growth at up to 5% annually, printing returns on that production, and paying us the shareholders via one of the most shareholders-friendly capital return policies in the market. Operating cash flow for the quarter of 1.84 billion was a bit shy of the 1.99 billion expected. After accounting for all capital requirements, a free cash flow of 1.3 billion came out short of expectation of 1.38 billion. However, Like revenue and EPS, both of these metrics also surged from last year's COVID depressed levels. Looking ahead, the team said it will continue to prioritize free cash flow over volume growth. For the second quarter, management is targeting 585 to 604 thousand barrels of crude oil equivalent, about in line with the 592 MBOE per day expected. Regarding the free cash flow target, the growth assumes $100 per barrel of West Texas Intermediate crude prices, with Henry Hub and natural gas liquids realization of at 40% of WTI. Based on a roughly 40 billion market cap, this amounts to a free cash flow yield of 60%. Next, we're talking about a deal that Devon has done to add to earnings, shareholders' return, and oil production. It will acquire the leasehold interest and related assets of Windward Oil and Gas, a private held company of Warburg Pincus. Windward is located in the Western Basin, a resource-rich body of land that stretches across Montana, North Dakota, South Dakota, and Canada. At a total cash consideration of $865 million, this is a small deal relative to Devon's size and roughly $15 billion in market cap, but it's one worth exploring due to its numerous benefits. Devon management outlined four key highlights of the transaction. First of all, thanks to the attractive valuation of 2.2 times cash flow and a cash flow yield greater than 25% at strip pricing that Devon is paying for the assets, management expects this deal will be immediately accretive to all relevant pre-shares metrics in the first year. Accretive is M&A slang for increase, meaning the deal will be attractive to Devon Energy cash flow, free cash flow, and net assets value by around 3 to 5% according to the company. Fourthly, we'll be talking about the company's most recent quarterly report. Devon Energy recently reported its second quarter results. Total revenue of $5.63 billion crushed expectation of $4.21 billion. Adjusted diluted earnings of $2.59 per share were better than the $2.37 the street was expecting for. Moreover, the company is prioritizing cash returns to shareholders over energy production growth. While the average realized oil equivalent price was a tad below expectation, it was nonetheless up significantly on both a sequential and annual basis. More importantly, both operating cash flow and free cash flow, the latter of which is key to cash return to shareholders, came in well above expectation. Operating cash flow for the quarter of $2.68 billion was better than the $2.38 billion expected. After accounting for all capital requirements, free cash flow of $2.11 billion came well above expectation of $1.79 billion. According to Devon's earnings press release, this represents the highest quarterly amount of free cash flow in the company's 51-year history. The strong cash flow realized in the second quarter allows management to announce a 22% raise to the company's fixed plus variable dividend payout to $1.55 per share. That's up from $1.27 previously. At a 62 share price for Devon stock, that annualizes a 10% yield. Dividends payments are only one way that management returns capital to shareholders, the other being share buyback. On this front, management note that since the inception of Devon's $2 billion share repurchase authorization, the team has already returned $1.2 billion to shareholders, retiring 4% of shares outstanding at an average price of $50 per share. Finally, we'll be talking about why I will still continue to purchase shares in the company. Due to both rising inflation and interest rates, Staying in growth stocks is suicidal in nature. There's only one type of company that I could invest in. Hiding in bonds is not great either as rates are steadily rising. The only way to earn a decent profit or at least make a slight loss is by parking the money in various companies. Due to the conflict, oil companies are getting a boost. As many Western countries move away from Russian oil, many countries start to purchase oil and natural gas from the US. Therefore, oil companies have been on the run recently and I was late in the trade. However, I decided to buy more shares so that I can enjoy a high dividend. So why did I sell off parts of my position in the company recently? Due to the sudden run in its stock price, I feel that it is prudent that I scale back my position. However, if its share price will ever come down in near term, I might come in and repurchase the shares that I have recently sold. However, if its share price continues to rise, I might sell even more of my shares into strength. In both ways, I'm benefiting no matter where the price moves in the short term. In conclusion, I strongly feel that Devon is a great company and a great hedge. Even though many investors feel that oil company share price should come down in the short term, this will mean that I could continue to buy more shares and increase my dividend rate. As oil companies will continue to prosper with high oil price, I will continue to enjoy high dividend while waiting for the market to recover. That's my personal opinion. With that, thank you. Have a nice day. Goodbye.